friends, today we will have small briefing on working capital appraisal and assessment. Let us see what is working capital. Let us see small definition of working capital. The term working capital is used to denote that sum of money required by any business enterprises for purchase of raw material, stores and spares, payment of wages to workers and employees, discharge of other obligations toward energy, fuel, water consumption, statutory dues, taxes, carriage inwards, outwards, excise duty, etc. And these expenses generally form part of working capital or that a capital fund which is required for keeping the wheels of production going. Let us have a overview of two major forms of extending finance. One is short-term finance, second one is long-term finance. So, in respect of the short-term finance, it is extended in the form of working capital limits, WCL. And principal operating account is known as cash credit account. Okay, cash purpose of extending working capital limit is for financing building up of current assets. Let us discuss afterwards. And normally working capital are extended for a maximum period of 12 months. Okay, please note it. And working capital are repayable on demand. Whenever you demand, it has to be repaid. Outstandings in the CC account, that is cash credit account, are liquidated by the sale of current assets financed by the bank. Long-term finance. It is extended in the form of term lending, and principal operating account is known as term loan account. And purpose of extending term finance is normally for acquisition of fixed assets. Normally term loans are extended for a maximum period of 8 years, and in respect of agricultural advances, they may be extended another 1 or 2 years. And term loans are repayable in installments ranging over number of years. Okay, please note it. And then outstanding in the term loan, this is very important. Outstanding in the term loan account are liquidated by generating of internal cash accruals. What is internal cash accruals? Profit after tax plus depreciation plus deferred tax liability plus amortization if any. Okay, all these are called as internal cash accruals. Nothing but it is the working capital is liquidated by the sale of current assets financed by the bank, whereas term loan installments are repayable from the internal cash accruals. This is the difference. So, the gross working capital is referred to an total current assets and working capital requirement. That is, gross working capital equal to total current assets and working capital requirement. The total current assets for the purpose of achieving particular level of production and sales will have to be funded by 4 important sources. What are those sources? Let us see. One is sundry creditors, trade and other current liabilities, that is called as OCL. Then net working capital, NWC, and assessed bank finance, ABF. Let us see the working capital and various sources of finance. Raw material, stock in process, finished goods, debtors and other current assets. Here we will see the various sources. One is other current liabilities and sundry creditors, then bank borrowings and net working capital. Okay, these are the sources of working capital finance. The buildup of total current assets is also funded by the market sources, that is sundry creditors. Then some portion is financed by the borrower's margin also, that is net working capital, and the balance is by the bank, that is called as assessed bank finance. Let us see the current assets here. What are the current assets? The term current assets is used to designate those assets that in ordinary course of business can be or will be converted into cash or sold or consumed. Usually the current assets are cash and bank balances, investments, receivables other than deferred receivables, and raw materials, components used in the process of manufacture, work in process, finished goods, advance for purchase of raw materials, and others, some other like advance payments of tax, etc. will also be called as current assets. The invisible current assets also. One is advance payment to labor. Labor will not come unless you pay some advance. And stock of consumable spares. The spares will not be visible in the manufacturing process, they will be used. And stock of consumable stores, and investment of short-term nature and short-term deposits with the bank, and margin money for LCs. LCs means letter of credit, and bank guarantees, and royalties for the current year, advance payment of taxes, and contingency payments. All these will come under invisible current assets. Current liabilities are those liabilities intended to be paid within 1 year out of current assets or out of the income of the business. What are the current liabilities? One is short-term borrowings from banks and others. Okay. Then unsecured loans. Then public deposits maturing within 1 year. Then sundry creditors. In trade, they will receive sundry creditors. That also will be called as current liabilities. Then interest accrued but not paid. It has to be paid. So deposits from dealers also will be dealt with current liabilities. Term loans due within 1 year, and statutory liabilities and other current liabilities. All these are called as current liabilities. Let us see what is working capital gap. The working capital gap is the difference between current assets and other current liabilities, OCL. And here the bank finance to be excluded. So in other words, working capital gap is nothing but total current assets minus other current liabilities. And this working capital gap has to be financed from the net working capital or assessed bank finance or both. See, liability and asset. Capital, it is a liability. Term finance, this is also a liability. Then fixed assets, these are assets. Miscellaneous assets, and bank working capital finance, then other current liabilities. Okay. Here these are the current assets. Now we will see this is liquid surplus net working capital. Okay. Then here this working capital gap. Let us see the operating cycle. Briefly speaking, working capital should be sufficient to meet the needs of the unit. So, operating cycle is the time taken from cash outlay for purchase of raw materials to cash realization by the sale of finished goods or receivables realized. Okay. So, this is called as operating cycle. Let us see the operating cycle. It is nothing but cash to cash. Cash, then raw materials, then stock in process, then finished goods, then book debts, then again cash. So this is operating cycle. Operating cycle process are, one is acquisition and storage period of raw material. Second one is production cycle, that is the period of process of converting raw material into finished goods. And third one is the average period of which finished goods are to be stored before releasing for sale, and average collection period of receivables. So all these to be calculated in the operating cycle. Let us see small example of the operating cycle. Let us see the operating cycle. Here cash and raw material, stock in process, finished goods, receivable, and it will be converted into cash. And time required for this one we have to take. This is trade credit, raw materials you see. Let us here raw material, it requires holding period 60 days, then stock in process, finished goods is 20 days, and receivables is 30 days. Here profit also we will receive, then it will be converted into cash. So length of operating cycle here is 120 days, that is 3 cycles per year. Let us see different methods of working capital assessment. One is operating cycle method, second one is permissible limit method, third one is projected balance sheet method, and fourth one is projected annual turnover method, that is also called as Naik committee method, then cash budget method. Okay, let us see operating cycle method. For small units we will use this operating cycle method. Suppose if a unit is operating cycle of 30 days and monthly expenditure of 30,000, then the total buildup of current assets will be 30,000. Whereas in the same unit, if the operating cycle is 50 days, then the monthly expenditure is 30,000, then the total buildup of current assets will be 50,000. And these total current assets to be financed by other current liabilities, net working capital, and bank finance. Let us see the operating cycle method. Here we have to calculate the operating cycle, that is for raw material storage 15 days and stock in process 2 days and finished goods 8 days and receivables 15 days. Receivables means once we sold the finished goods, the amount what we have to receive, that will be around 15 days. So total length of the operating cycle is 40 days. Let us see the particulars here. So here the sales 13,000 and proposed is 20,000, and on that basis we have to fix a working capital. Let us see the sales. Existing 13,000 and the borrower proposed 20,000. Raw materials, so out of sales the raw materials will be proposed will be 13,000, 4,000 and 1,000, that is expenses as well as drawings. So total monthly expenses what he proposed is 18,000. So let us calculate working capital required. Total length of operating cycle into monthly expenses divided by 30, so that we will get per month. So working capital required is 40 days, that is 40 days into 18,000 and divided by 30, it is coming to 24,000. Let us say margin, that is 4,000 from the customer. Bank borrowings are 20,000. So like that we have to fix the working capital in respect of the operating cycle. See, measuring of operating cycle. Stage wise monitoring not possible, but rely on averages. So here holding ratios, raw material holding, stock of raw material into 365 divided by annual consumption of raw material. Then SIP holding, that is stock in process holding. Like that we have to calculate. Here stock in process holding we have to take into consideration cost of production, whereas finished goods holding we have to take into consideration cost of sales. Here you see cost of sales. And receivable holding also annual gross sales, and advance paid to suppliers, annual purchases. Trade creditors holding, here TC level, that is trade creditor level into 365 by annual purchase. Then here advance received against sales, that is advance received into 365 by annual gross sale. So here like this we have to calculate the holding ratios. Let us see the permissible limit method. Here, bank provides working capital finance to hold an acceptable level of current assets, that is raw materials and finished goods and receivables, etc., for achieving the predetermined level of production and sales. Okay. So, the assessment of funds required to be blocked in these items, that raw material, finished goods and receivable, etc., is the total working capital requirement, which must be financed through net working capital, other current liabilities and bank finance. And minus the margin is nothing but working capital limit or traditional method. Here sales 10 lakhs, cost of raw materials 6 lakhs, cost of production 8 lakhs. Then holding levels means how much time we have to hold the raw material stock in process. Here raw materials 1 month we have to store, and stock in process it requires half month, and finished goods half month, and receivables around 1 month, and expenses, okay, 1 month expenses we have to take, and sundry creditors 1.5 month. All these things, holding levels, we have to take into consideration while fixing the permissible limit method. Here liquid surplus available with the customer, that is current assets minus current liabilities, that is 6 lakhs. Then if you fix the margins, we have to fix like this. A raw material it requires 1 month now, so working capital required is 6 lakhs. Here you see 6 lakhs and margin is 25% and permissible limit is 4.5 lakhs. Like that we have to calculate for stock in process and finished goods and receivables and expenses. For each we have to calculate permissible limit. So total it is coming to 14,70,000. Let us say this is C. Here while fixing the working capital limit, we have to reduce the sundry creditors. So the sundry creditors available for the customer is half month, that is 3 lakhs. So already liquid surplus 6 lakhs he is having. So the sundry creditors let us say D, and liquid surplus let us put E. So total 9 lakhs is available with the customer. But actually bank finance required A minus F, that is 70 lakhs. So limit recommended not more than C, that is 14.7 lakhs H. So deficit A minus F plus H, that is 2.3 lakhs. So normally this H, that is limit recommended, should be less than or equal to C. C means permissible limit, that is 14.7 lakhs. Let us say what is A, that is working capital required, and what is B, that is margin, and C means permissible limit. F means this is liquid surplus plus sundry creditors. That we have to take into consideration, that source we have to ascertain how the borrower is going to get this deficit, that is I. So in this way we have to calculate the working capital under traditional method. The holding pattern of raw material. The factors we have to see while accepting the holding level of raw material. One is the average consumption and holding. Then here economic order quantity and minimum order quantity, and suppliers, whether they are from government or local or foreign. Then seasonality, perishability, perishable means spoil, and credit availability, cost of holding, and criticality, and transport cost. Suppose we have to see this transport cost, very important, and then storage capacity. Once raw materials are received, if you are not having any go down or storage facility, they will be perished if you keep outside. So all these things we have to take into consideration while accepting the raw material holding paid. Same fashion, we have to see the holding pattern in respect of work in process. What is that? Process and processing time, then technology used and product range, whether different products they are producing or single product, then capacity mismatch, any bottlenecks, any problems, and production cycle, and number of shifts worked. Sometimes it is 2 shifts, 3 shifts also. Estimated level of finished goods, estimated level of holding of finished goods. Okay, whether the unit is having firm orders or anticipated orders. Second one is minimum dispatch quantity. Third one is buyer's profile, whether the buyer is government, local or foreigner. Then supply terms, then availability of transport, then seasonality, then marketing arrangements, direct or dealers, then demand for the products, that is also one of the important area, and carrying costs and impact of estimated profitability. So if cost is more, then it will impact the profitability, and perishability, availability of proper storage arrangements. All these things we have to see in respect of holding pattern of finished goods. Holding pattern in respect of receivables. Once you supply the goods, you have to get the money. So here we have to see trade practice, whether they are going to give 30 days credit or 60 days. In respect of the cloth, they will give even 2 months credit also. Then marketing arrangements, whether directly or through dealers. Then customer profile, whether he is a old customer, new customer, whether he is a government or local or foreign customer, all these things we have to see. Then market conditions and market position. Then bulk orders and sales also we have to see in respect of the receivables. Then seasonality. Here we have to see the holding pattern of creditors also. So what are those? Let us see. A reputation of the unit in the market, then cost, then what are the trade practices and market practices, and what are the market conditions, what is market positioning, and what are the bulk sales, and what is the credit policy, and what is the liquidity. All these things we have to take into consideration while accepting the holding pattern of the creditors. The projected balance sheet method, PBS we will call it as. This method covers analysis of the profitability of a borrower's business, past and future, then funds flow, past and future, and critical parameters like profitability, liquidity, gearing, etc. All these will be analyzed here. In respect of the projected balance sheet method, the quantification will be carried out flexible manner with the proper examination of all relevant parameters and their acceptability of each case. Here, which is the key determined for working capital limit, will be the extent of financing support required by the borrower, one, and the acceptability of the borrower's overall financial position, including the projected level of liquidity. All these things we have to see in respect of the projected balance sheet method. See the projected balance sheet method, that is PBS method. Here, no maximum level of current assets. We have to calculate based on needs, trends and comparison, and no minimum level of liquidity. That current ratio of 1.33 only a benchmark. And third one is avoids dual approach to certain items, that is term loan in installment, LC bills. So the validation of bank finance is on the basis of analysis of profit and loss account, balance sheet and funds flow, and detailed scrutiny of operating cycle, projected level of operations, nature of build-up of current assets and current liabilities, profitability, overall gearing, all these things we have to calculate in detail, and it is a flexible approach. Limits for LC bills are outside assessed bank finance. So this is projected balance sheet method. All these things we have to take into computation. Projected annual turnover method. Under this method, working capital requirement is computed at a minimum of 25% of the output value, out of which 20% will be the financed by the bank and 5% will be the borrower's margin. In other words, working capital credit limit should be computed at a minimum of 20% of the projected annual turnover. Now let us see projected annual turnover PAT method or Naik committee method. Here it is very simple. 25% of the projected annual turnover to be financed as working capital requirement. Out of this working capital requirement, 80% will be bank borrowings and 20% by the borrower margin. Okay. Here 20% of the PAT to be financed by bank borrowings and 5% of the PAT to be financed by the borrower's margin. Okay. Are you understood? Here total 25% of the projected annual turnover to be financed as working capital, out of which 20% is bank finance and 5% is the borrower's margin. So now let us see projected annual turnover. Here projected annual turnover is 120 lakhs. So working capital required 25% of the projected annual turnover, that is 30,000. So minimum margin from the borrower is 20% of the B, that means 6,000. So minimum bank borrowings will be 80% of the B, that is 24,000. Let us see, just you see and understand. So actual net working capital available from the borrower, that is 5,000. So margin stipulated higher of C or E, that is 6,000. So limit permissible will be B minus F, that is 24,000. Let us see the cash budget method. Cash budget method is used for assessing the working capital finance for seasonal industries like sugar, tea, etc., and also for construction activity and also for IT industries, information technology. So here the cash budget analysis is used for sanction of ad hoc working capital limits. Let us see the cash budget method. Here particularly month wise we have to take. In January the sales are 1 lakh, out of which cash sales 20,000 and credit sales 80,000. And total cash inflows, please see it, that is 1 lakh. And credit purchases 40,000, miscellaneous purchases 2,000, and manufacturing expenses 35,000, selling expenses 10,000, interest on working capital 1,000. So total cash outflows 88,000. So already opening cash balance 22,000, and the unit has to maintain closing balance of 50,000. So here the deficit is 16,000. Just to calculate, 22 plus 1 lakh, that is 1 lakh 22 minus 88, it will come 34. But the unit has to maintain 50,000 na, so the deficit is 16,000. So for January the limit is 16,000. Like that you have to calculate for other months, and the maximum this deficit to be given as working capital for that unit. So under this cash budget method, besides the cash budget, we have to see other aspects also. What are those other aspects? That is, one is examination of funds flow, profitability and financial parameters. Okay, all these things we have to see in respect of the cash budget method. In respect of the manufacturing and trade units, we will see up to certain limit. That PAT method we will follow. That is, PAT method means that is Naik committee method, that is projected annual turnover method. Then projected balance sheet method also we will follow. So these two methods we will follow depending upon the limits. respect of the manufacturing units, we will follow PAT method or traditional method, and also projected balance sheet method depending upon the limit. Respect of working capital requirement of non-banking finance companies, NBFCs. Okay, it will be assessed on the basis of minimum current ratio of 1.33. 1.33 means that is current assets divided by current liabilities. It should come 1.33. The mechanics of lending. This is very important. The appraisal, what we will call it as appraisal. The appraisal procedure will consist of thorough analysis of borrower's total business operations, then financial position, then management capabilities, etc. And also it also involves analysis of borrower's profit and loss account and balance sheet and funds flow, and for the past periods to examine performance. What is the performance? That is in performance in terms of profitability, financial position and financial management, etc. All these things we have to verify in respect of the mechanical lending. Here, collection of financial data. For working capital assessment, what are the required? One is particulars of existing and proposed limits from the banking system and information on associate concerns and operating statement and analysis of balance sheet and comparative statement of current assets and current liabilities and funds flow statement. Okay, all there we have to see the peak and non-peak limits also. A separate limits wherever feasible and necessary may have to be fixed for the normal peak level as well as non-peak level credit requirements along with the expected period of utilization as per the utilization. For this purpose, we have to verify past trends in the utilization of the facilities should be verified. Ad hoc limits. The request for ad hoc or excess finance should be entertained as an exception and only for genuine short-term credit requirements arising out of unforeseen contingencies faced by the borrowing company. And the request should be clearly spell out the specific need for the additional finance thought. This is in brief about the working capital finance.